Hey, Albert.
Hello, everybody.
Hey, Dr. Sanders, how's it going, sir?
All right.
Good. You work in summer school?
No, I'm helping write math curriculum.
Oh, okay.
Have fun.
2 weeks down.
Okay.
Weeks down, how many left?
2.
Okay.
End of June.
Okay.
Hey everyone.
Who is that? Martell?
It's Martell, yeah.
Hey, Martell.
Hey, how you doing?
Fine. Is you had a boy, right?
Yeah, I had a boy. He's a little over
So-
a month old now.
Okay. Is it Martell Jr.?
No, nah, he's Maverick. We have a 5-year-old named his name is Caleb, and the one that's 1 month old, his name is Maverick.
Okay. All right then. I thought we had a Martell Jr. I wanted to ask.
Nah.
Okay.
Nah.
Congratulations, sir.
Yeah. Congratulations. Yeah.
Thank you.
You get 3 more boys, and you have a basketball team.
Right. Yeah, this probably be it for us, especially with
Oh,
Oh,
the
no.
lack
Who
of
says
lack
girls
of
can't
sleep
play on
we've
the
been getting.
basketball team?
What'd you say, Al?
I said, who say girls can't play on the basketball team?
Oh yeah, but I mean in general. But I wasn't
know.
trying to. I wasn't trying to slight anybody because you'll have people writing more letters to me. I don't need any more complaints.
Yeah. Mm-hmm.
Well, we are live, so
Okay, yeah, we are. Okay, are we ready to start, Al?
Oh, yeah, let's get this investment committee meeting started.
This meeting is being recorded.
At least that wasn't recorded. But let's get our meeting started today, June 15th, 2024. The time now is 4:33. Sue, can we get a roll call?
Angela Banks,
Here.
Christina Bennett, Lewis Cross,
Present.
Sheila Goodwin, Shanice Johnson, she can't make it, Donna Jones, Yvette Levy,
Here.
Martell Mann,
He's
Here.
here. Oh yeah. Okay.
Bobby Richardson, here, Albert Sanders,
Here.
Doris Walker.
Here.
We do have 6, so we have a quorum.
Okay.
I think we have a couple reports that are going to be done today. And I don't think we have any other business today, Sue, besides our.
We do have a late update, and I think that's where we're going to start to talk about Exponents came to us with a proposal. But Jeff, I don't know if you want to kick it off.
So they're in the waiting room. They wanted to have a few minutes to discuss this, but Gwilda and I already had a conversation with Exponent. So in summary, what they're looking to do, and there's a lot of moving pieces behind it, but for their global equity portfolio right now, they have multiple custody sub-accounts for their sub-advisors, and they have proposed a more efficient structure for that, whereby they would be able to consolidate 3 out of 4 of the custody accounts, and that's going to help them on several fronts. Number one, through efficiency of trading, being able to deal with certain size minimums and things that allows them to potentially invest with other investment managers, and would also allow their current managers to make direct investments into emerging markets. So right now, a couple of their managers do have emerging markets exposure through exchange traded, or not through, through American depository receipts, ADRs. Those are essentially non-US stocks that trade on US exchanges. Those can act a little bit differently than things that invest directly in local shares in international markets. So they would like to have the flexibility to do that. And their investment policy allows it. They just haven't been able to do it because of the custody structure. So what they're proposing is a revised custody structure. Again, I don't want to get too far into the weeds because that's what we've asked them to come on and just go through. But I would tell you from the standpoint of Gwelda and I took a look at it, looked at the proposal. Basically what they're looking to do ultimately ends up with more efficiencies in the structure. Ultimately, once we and we'll talk about custody a little bit later, the fewer custody accounts that we have, we actually pay less for custody because a lot of custodians do charge by the number of accounts. So it'll help on that front. The reporting generally will not change, so we'll still get the same level of transparency that we've had before. Again, there's no change to their investment policy or to their structure, but they do believe with this structure, they will be able to diversify out further. So even add another manager or two to the structure. So, and then no change in the overall costs or fees of the structure. So we sort of view it as quite a few positives in it. So again, we'd like to let them explain it, but from our standpoint, we don't have any major objections to it. But again, we wanted to give you all a chance to hear it directly from them and then ask any questions that you might have. So with that said, if Sue, if we don't have any questions, maybe we can bring Exponents on.
Okay, yep, they are in the waiting room.
Hey, Sheila, you're not on mute. There you go.
Yes, I am. Did you need me?
No, not at all.
Afternoon.
Good afternoon.
Good afternoon.
So Tina, is just you and
How you doing, Tina?
Tom from your end?
Yep. How is everyone?
Doing fine. Good to see you.
Good
This
to
is
see.
Lewis. Good to
Yep.
see you.
I see you, Lewis, and
Yes.
and I see Christina coming in and Sue, and nice to see her. Thank you for allowing us to, should I start or?
Sure, Tina. I just
Okay.
gave everybody I just gave everyone a 30-second overview
Okay.
of what you're looking to do here, but I thought I would leave it to you to get into a little bit more detail.
Well, thank you. Well, I want to be respectful of your time, so that I'll just get right in and go to the next page beyond the title page. Look, I first want to thank you again for this opportunity. And the goal here is to continue to do what we do. We're not asking for any change in the guidelines or anything, but we simply want to implement an account structure which provides for more manager diversification, and so kind of can improve performance and is more efficient administratively, reduces the operational burden on Sue and places it where it belongs on ourselves, and enhances our flexibility and risk management. There are a lot of words on this page, and I'll rather go to the next page where I can show with a picture what all these words say. So, so this depicts your account structure. As you know, we are a manager of manager, and so underneath us are several managers. And so the blue circles show or the existing managers in the account. And what it does, the structure of this is to show how we diversify your managers relative to different phase of a typical market cycle. So manager A, for example, does well early in a market cycle when, I don't know, the Federal Reserve is easing or central banks writ large are easing and people and the economy is just recovering, whereas manager D does well in the opposite market. They would do well in the midst of a recession. So basically we're structuring a portfolio that does well in different market environments. What we're trying to do is, as you see from the green circles, obtain greater diversification. But to do so, we need a more efficient structure. And that's really our point with diversification. And so on the next slide, which my colleague Tom Quinn, who is here, will go into kind of will describe why this portfolio structure, which we have in place for several other clients, is more efficient and will, facilitate our need for greater diversification. And again, equally importantly, reduce the administrative burden on your executive director and your custodian accounting. So with that, Tom?
Thanks, Tina. So what this account structure does is essentially it combines the benefits of a separate account as well as if any of you are familiar with a model delivery type of service, and essentially will consolidate the investments of multiple sub-advisors into a single custodial account. Now, we have the infrastructure set up so the managers will see their portion of the account as if it's a segregated portfolio. They have full control to trade on the account. All of the trades are aggregated at the end of the day and executed together on the close for whatever market the trade is set up in. But what it allows us to do is then to make changes to the portfolio where in the future there's no custody accounts that need to be opened. And the more painful aspect of that is setting up the trading authority in the various markets. Once that's set up moving portfolio managers in and out becomes a seamless process, much more efficient. And we can do that. Doing that allows us to increase the diversification without increasing the number of custody accounts and all that account opening process. There's no change in the management fee or the guidelines. The current managers will all be included. The additional managers that we are potentially adding would increase the diversification and maintain the diversity composition of the managers in the portfolio. And we would still retain full, sub-manager level reporting so you can have full transparency to the aggregate account as well as the individual sub-accounts. Any questions on that structure?
You're basically creating a mutual fund for efficiency and reduce expenses.
Yeah, I mean, that's one way of thinking about it, but it would still be a separate account of one. So it's a single, but from a practical standpoint, it would, you can think of it as ease of use, much like a mutual fund.
Correct. Okay.
Right.
And Tom and Tina, does this structure at all impact the ability to continue to meet the MWDB brokerage requirement?
No, we will still be able to meet that. We can direct the trades however we see fit, and we have other clients where that is a requirement that use the structure and with no problem meeting it.
Great question. I think this looks great. I mean, if it's going to improve efficiencies all around, I'm all for it.
And one thing, I'll just throw this in too, because I know one thing as we were discussing this with Sue just wanted to confirm, well, there's a couple moving pieces because we have a custody search that's out there. And so potentially, if the trustees decide that they want to change custodians, does that end up being an issue in one respect? And so I know, and Tina, you can confirm that it would be your preference to try and get this done before any change was made. So that was sort of number one. Number two, you all reached out to US Bank in our context to discuss this structure, and correct me if I'm wrong, they said they would be able to do it. But I guess one thing that we didn't talk about the other day, if you have an update for us, is how long would you expect this transition to take?
You know, so much of the answer to that questions depends on the bank. You know what I mean? So we can send account. Oh, well, the good news, first of all, is the current structure has, you know, which is the top of this page, you see something called the transition account, which is already in place. And so rather than setting up a new account for this structure, when Shalonda, who is the head of our operations, spoke with the bank, they confirmed that the omnibus account, which is below the one beside sub-advisory, the transition account can be repurposed, if you will, into this omnibus account, or the one called Exponence IMP. And so they're not setting up a new account. So, you know, I would say a month or two, but so much of the answer to that question depends on the machinery of the bank itself. I mean, we've done this a number of times. We have other clients, but we've seen some banks that are really slow and others that are lickety split. So I would sort of estimate a month or two.
Okay, so but again, I think we're just trying to make sure that there would be at least enough cushion that would be complete with enough time before now in the end of the year. If again, should a custodian change need to be made?
Yeah.
So
that would be record setting slow if we are if we're still doing this at the end of the year.
Okay. Anyone else have any questions?
I think you're on mute.
I am. I'm sorry. I'm looking a different way because it's fiscal year end, and I'm trying to book over 1,000 journal entries in the next 2 weeks.
Oh dear.
Yeah. So, what do we need next from us, Sue? Do you have
any other questions for Exponence, and then we can discuss?
Any questions from anybody else? Jeff, you're okay with this structure?
So yeah, again, Gwelda and I took a look at it, and again, we would, from our standpoint, everything that's being proposed seems logical, makes sense, adds value. And again, I know Sue had questions, and Sue, I don't know if you had any additional thoughts from an administrative and back office function on this, or if you sort of foresee that this would make your life easier. And it sounds like I think everything that the auditors would need from a position reporting standpoint, that all would still remain. So I don't foresee that we run into issues there. So I think from our standpoint, we didn't see any reason not to do it.
Okay.
Question,
Sheila?
how would this structure impact the portfolio? What's the downside of doing this?
You know, none that I can see. The one downside which we have solved for, you will notice in that chart that we just took down, it says Exponents IMP, and then it says Subadvisor A, right? And the reason why there are two accounts why that Subadvisor A exists is because that particular manager doesn't fit well into this structure for a number of reasons. And it's a really good manager. So again, our first goal is performance. And so we don't want to, in the effort to make a more efficient structure, hurt performance. And so the one downside is if we had to terminate Subadvisor A, but we're not. We're keeping one separate, one separate account for that subadvisor, and then
The rest of them.
you put in the rest in this IMP. I don't know, Tom, can you think of anything else?
No, and frankly, I mean, this is something we came to out of necessity for a corporate client that we were working with after working through a lot of iterations. And, frankly, if we would have been insightful enough to think about it earlier, we would have proposed it when we initially set up the portfolio. We're glad that we have the opportunity now to potentially enact it, but Tina mentioned kind of the only downside is not every manager fits neatly into the structure, but we figured out a way to be able to maintain the investment with that manager. So.
Sheila, does that answer your question?
Kinda.
How can we better answer it?
We don't have any additional fees associated with this new structure, right?
No.
Mm-hmm.
I have a question. This is Doris. Christine, do you think this is a good deal?
So when you do manager programs, you do add layers of fees. You don't pass them on to us, but there's still custodial fees that go with it. So I'm all about efficiencies without impacting performance. So if it's going to make it easier and we get the same reporting, the same service, and we don't get any additional fees that we have to pay out of this, and it improves the fee structures for on the custodian side, then I'm for it, as long as, like Tina said, we don't get rid of manager A. But to accommodate this, I think it's fine.
Okay, thanks.
As long as the accountants can get what they need for our fiscal year end reports, then how the sausage is made in the background, if we still get the same sausage, I think we're okay. Correct, Jeff?
Correct. Well said. And Tina, from an administrative standpoint on Sue's end, what will be required from her to do this, as far as is anything that she has to execute? Do you have, if so, do you have template direction letters that you can sort of have signature ready for her to do this, to kind of take the burden off of Sue in this process?
We certainly do. So the first thing, and again, we would provide direction letters to this effect, but the first thing essentially would be, should the board approve, it would be to inform the bank that, we are transitioning to this structure. And obviously the bank has to hear from the system directly. And that pretty much is it. But that direction has to come from an official source.
Question. Will this change the transparency of the program?
No, you will still get the same, you know, fund level and then manager, individual manager level reporting that you currently get.
Somebody needs to mute because there's some background noise coming in. I don't know from who.
Sounds like a TV.
Okay, I have, is it okay if this, oh, I'm sorry. Oh. let's see.
Go ahead, Louis.
Oh, okay. I think it's an excellent idea. And I think, I feel that it's right on time. If we're going to be saving on fees and that's a good thing because I know Christina and Al like to save on fees. And Tina has explained it very thoroughly that it's just a matter of how long it'll take the bank to do it. I think it's an excellent idea, and you all have my vote on it, Tina.
Well, I appreciate that, Louis.
Mm-hmm.
Thank you.
Sure.
So basically the changes would be in the reporting. Is that where?
No, it's mostly in the custodian relationships and the accounting. So again, we have 5, I think it's 4 managers plus us, right? So think of this, you have five accounts and we're collapsing that to 2. And so, you know, and I don't have transparency with your arrangement with US Bank, but I imagine there is some level of fees between you and the bank on an account structure basis. So it's basically fewer accounts. That's number 1. And then number 2 is as we change managers or change allocations among the existing managers, what happens is under the current structure is we would write a letter to Susan. Susan then, you know, then has to write a letter to the bank. This is the current structure. And then we talk with the bank and, you know, it takes 2 months and takes away from Susan's valuable time, just the sort of administration of that. Under this structure, if we want to, you know, if the account is $50, each manager has $10 and we want to give $5 more to one manager and take away $5 from the other, all we do is we don't have to involve Susan in the administration of that decision. She doesn't have to write a letter to the bank. She doesn't have to, all we do is actually increase the weight within our model of manager A versus manager B. Now, if Susan wants to be involved in the decision, that's a conversation, but she's not writing letters back and forth and dealing with transition managers. It's just a much easier way to do what we do. It's just a more efficient way to do what we do. And as Tom said, the reason why this came about is we were hired by a technology company, a corporations, where we do this strategy for their balance sheet. And they looked at the current structure and their head exploded and said, no, this is way too much aggravation and accounting and administration. And so this structure was derived from that conversation to do what we do more efficiently. And that, you know, they like it. We've implemented it, you know, for other clients. And it, again, it's the same thing, just being more efficient. As Tom said, I wish we had thought of it before the technology company said, I like you guys, but we're not doing this. But, you know, but that's how it came about, to accommodate a client. And so we're trying to make it available to other clients.
Well, the way I see it, Tina, is that we hired you for a specific dollar amount.
Yeah.
Right? We gave you the autonomy and authority to manage those, for you to select the manager of managers that would fit this mandate. Right. And so we've made some changes along the way. And so I think this makes it easier for you to be able to allocate assets or to reallocate the allocation as your team see fit according to what our mandate is.
So in a nutshell, it's a way of consolidating the administration of investments.
Yes.
Okay, I got you.
Mm-hmm. Are there any other questions from the committee? Sue, do you have
Yeah.
need a motion?
Yeah, I do have a motion, and you know, we don't have to hold up Tom and Tina, but just to let you know, this recommendation would still go to the full board, which meets a week from Monday on the 26th. So, I mean, we'll let you know kind of the progress of all of that.
Thank you very much for your time.
All right.
Thank you. Have a great evening. And I
evening.
appreciate your time.
Thank you.
Thank you so much, Tina.
Thank you. Take care, Lewison.
All right.
Bye-bye.
Would anyone from the committee like to make the motion?
I recommend to the Board of Trustees approval of the IMP account structure for Exponents Global Equity as recommended by Investment Consultant and Co.
Richardson,
second.
It's been properly moved in second. Any discussion? Hearing none. Sue, can you take a roll call vote, please?
Angela Banks,
Yes.
Christina Bennett,
Yes.
Lewis Cross,
Yes.
Sheila Goodwin,
Yes.
Yvette Levy,
Yes.
Martel Mann,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
Doris Walker.
Yes.
All right, so we have 9. The motion carries.
Thank you, everyone. Jeff, it's back to you on the agenda.
Okay, Sue, where do we want to go next?
Do you want to talk about the fixed income? Do you want to talk about the flash? We also have that little update on SVP. So it's whatever your pleasure is.
Yeah, why don't we save we'll save the flash report for last. So let's start with SVP. This is more of an informational item, but if everybody recalls, we made the recommendation for the private debt investment into SVP. And in that process, we came across the issue with the investment entity. So they initially did not have an onshore entity to invest in. So we went back to them and they said they could create that. So that's in the process right now, but then they came back with a few other questions and said, you know, please check with your attorney on, are they confirming that this is a tax exempt entity, which we can confirm. And then the other one that came up, they said, and this was, I know when we initially talked about this, they said, well, if we create the entity, we might have other investors that are interested in going into that same entity as well. I don't think they have found any at this point. So they came back and said, is there going to be an issue from your standpoint if you're the only investors in this entity? And again, so we wanted to make it clear to everyone that while you might be the only investor in this Delaware limited partnership, that feeds into another entity that actually holds all of the investments. And that entity itself has multiple investors that are going into it. So it's a little different. So if you compare it to Exponent's fixed income, where the system was one of maybe 3 sizable investors in the plan, and now they have to unwind it, and that might take a while because we didn't have a lot of investors, lesser liquid positions, so on and so forth. This is a little bit different. So it's again, it's a commingled structure of all the private debt investments they will be in, and it will have multiple different investors. So just being the only ones that are in this Delaware entity isn't there. There's really no specific risk in that if you're the only ones, because again, you're feeding into a larger structure. So again, more informational, but we just wanted to let everyone know that is still, it's in the works. They were asking these questions, and we said, well, if they're asking these sort of things, we should at least bring it back to the board and let them know what's going on there. But again, they're moving full. Well, I shouldn't say full steam ahead. They're still waiting for full board approval. And again, I know Sue has mentioned before. She said, you know, it could get full board approval, but then all documents still have to go to the attorney, and the attorney can still come back and have objections and issues. So I think SVP is very well aware of that still has to go through legal document review, and we could potentially have to have side letters and other things that have to get clarified. So again, I think they're understanding of that, and I think they're also understanding of the time frame of it, that we still need full board approval. Once that's done, we'll still need a fair amount of time for attorney review as well, and going back and forth. So I think they're well aware that it doesn't happen tomorrow. They're not calling capital tomorrow. That this could easily sort of go into early next year before we're potentially in a position where it's finalized and they're actually calling capital. So we'll keep everybody updated as things go along there.
And we've already had the investment committee make the recommendation to go forward with this, and it'll be a motion that'll have to be approved at the full board meeting on the 26th. So that's why we just wanted everybody to be aware, you know, we might be the only ones in that feeder fund.
A quick custody update. Again, everyone knows there's an outstanding RFP that's gone out to all the banks that we talked about at the last meeting when we discussed custody. We had a a bunch of the custodians asked questions. We did a consolidated Q&A. That all went back to all the respondents. We did have 4 BNY Mellon, JP Morgan, Principal, and Morgan Stanley that ultimately have come back and said that they are not going to bid. So they are out. And
Can you repeat that?
Yes, BNY Mellon, JP Morgan, Principal, and Morgan Stanley have said they're not going to bid. And the only one that really gave us any sort of detail there was Principal, and they just said they don't have a facility to do securities lending. I suspect on everybody else's part, it was probably just more of pricing and moving pieces. And I think that each one of those are sort of notorious for, in particular, BNY, JP Morgan, Morgan Stanley, for really going upstream, and now they're only dealing with mega multi-billion-dollar plans where they can also sell a lot of investment product. And because that was something that was also has been outlined or has come up in the Q&A. So I think a number of them have seen some broad strokes on the portfolio, and I think they understand that there's just the way it's structured and it's very much an open architecture investment plan that we're not gonna, if we use BNY as the custodian, it doesn't necessarily guarantee them that we're going to use a bunch of BNY product or JP Morgan, Morgan Stanley. They're sort of the same. They're out there sort of looking for the clients that do everything with them, do their custody with them, does all the brokerage through them, does, uses a lot of their investment products, things that get really expensive. So I think they kind of understand that structure and that your group just doesn't operate that way. And so we suspect that's probably why they are out. So.
Question.
Yes.
So what companies or what banks are in the running still that can still do this that are at a major bank level? In other words, not a U.S. bank is a regional bank?
Yeah, U.S. Bank is still involved. Commerce Bank is still involved. And again, give me 2 seconds so I can pull up the.
Okay.
Sue, I don't know if you have quick access to the custody report that we did. If not, I can just pull it up and read off of it.
And we might get there at the same time.
Yeah, we'll see who gets there first.
Yeah.
My money's on Sue.
Oh, no pressure.
I'm trying frantically here. Okay, well, while Sue is pulling it up, I'll just read off what we had. So this was our initial list was US Bank, BNY Mellon, Comerica, Commerce, Northern Trust, PNC, Regions, State Street, UMB, and then recall we added JP Morgan, Principal Morgan Stanley.
Okay. So has everybody else replied?
So no, so everybody we've given the deadline of June 30 to actually submit their proposals. So, but nobody else has come back, said they're not submitting. So for all intent and purposes, we believe everybody's in. Lewis, back to your question on this, Northern Trust would still be one that's of the scope that you're thinking of, as well as State Street. Now, again, State Street, I sort of put in that category of the others that I mentioned that have really gone a lot further upstream. So
I was going to say, I think we're
sort of
too
surprised
small.
that they haven't bowed out yet. So
I guess my concern is that with all the issues with the banks, the regional banks, and because of the new language that was inserted during the Trump administration, that has kind of caused a lot of the regional banks to get in trouble because they were not really scrutinized like they had been prior. And I guess that's why I was hoping that we could get a bank that was one of the larger banks. But I think, as Christina has shared with me on numerous occasions, we might be too small for anything other than a regional bank. Is that true?
So State Street probably has moved up the ladder. They may or may not, or they may price it too high for us. But when you look at PNC, so UMB and Regions and Commerce are probably more Midwest banks, or and South. When you look at US Bank and PNC, they have a lot more national presence. Obviously State Street has national presence, but they're mostly on the East Coast, and they go up pretty high. Commerce has an office here in Kansas City. I'm not really familiar with Comerica. Mellon, obviously Pittsburgh based, but they're pretty big in the custody as well as in the with the Federal Reserve and collateralization. US Bank is pretty much, I'm not sure if they're nationwide. So UMB and Regions of South as well are more regional with Commerce, right? They're predominantly Midwest and South. Northern Trust is pretty big. PNC is pretty big. US Bank. And I'm not familiar with Co-America, so I can't say anything about it. But State Street obviously is the biggest one on that list that has that. We'll wait to see what they say. But you do have a good selection of custodians at the moment. Now I've started working on my custodial RFP as well. So I mean, if those said no to us, God forbid, that they're not even going to be on my list because we're a fraction of what the assets are here. But you do have a good listing here.
Now, is it true that the deadline is June the 30th for other banks to apply, or is that correct?
Yeah, for everybody that's in the process, yes, it's the June 30 is their deadline to submit their proposal to us.
Okay, I got you.
Yeah, but
Okay,
I don't think you can come off the street out of the, left field and be able to apply. Correct, Jeff?
Well, Sue, Sue, you did do some sort of public posting, did you not?
We did not, no.
Okay.
Yeah.
Then no, nobody would be able to jump into the process. And I think if anybody were to have caught wind of it, they would have I'm sure they would have contacted us first. So
I see.
Yeah, I mean, they could learn about it through our, these meetings or, live stream, so people could see about it that way. But yeah, it was not posted on our website.
Yeah.
Yeah, and Louis, one thing I do want to clarify as well is that with respect to these custodians and their operations, they're all what we call qualified custodians, which basically means they have to segregate all of their custody assets. So none of that can be intermingled or intertwined with any of their business. So if they were to have a banking crisis, a run on the bank like Silicon Valley or some of those other banks did, it wouldn't impact you. You wouldn't, and none of the system's assets would be at risk. The only thing is it would be a headache because they would say, kind of like what happened over at Silicon Valley Bank. Anybody who didn't really have that kind of exposure that was just had to do capital calls or things through Silicon Valley Bank, it just had to get all transferred to whatever bank took them over. So that's the biggest risk is it's a headache factor and probably, unfortunately, more of a headache for Sue than anybody. If one of these banks, something happens to their banking operation, they'll say, okay, well, then we have to, our custody business has to get absorbed by somebody else. So then all of a sudden, US Bank now becomes a part of Northern Trust and all of the things that have to go through to deal with that. So that's probably the bigger, and I don't even want to call it a risk. I would just say more of an administrative headache for one of these banks having some sort of traditional failure.
Question, is it a common practice for the custodial banks to charge fees for deposits?
What do you mean by that, Louis?
It's my understanding that when we make deposits of funds into US Bank, there's a charge for that. Is that correct, Sue?
Yeah, that's on our regular bank account.
Yeah.
We have all kinds of fees, and yes, deposits are charged to us, yes.
So
Okay,
Louis, that's on your banking analysis statements, not on your custodial statements. So if you recall in the banking industry, you used to go to the branch and they would always have like a commercial line, or when you would be able to drive up, you would have a commercial line just for cars to go to. Those don't exist anymore. So the branch centers don't want commercial deposits anymore. Everything's usually done remote and whatnot. Through a remote deposit. So even if I go in and walk a deposit in, sometimes they can charge me $2 to $3 to deposit my own money. So it really depends on how many deposits you have and what's included on your analysis fee. And I'm really good at structuring and beating up banks when it comes to reducing the analysis fees. So I can get with Sue and give her a template and we can look at it, and then we can really figure out how to save on that part of the business for fees. I work with 15 banks, and I tell you, every single one that meets with me or tells my boss that I beat them up, because I want I want less fees and I love free. So,
Okay.
so we can work on that on a side note.
Okay, and still, Christina, my question is, and you partially answered it, but was asking, is that a common practice to charge by all of those banks? Is that a common practice?
Yes.
So Louis, just on the custody side alone, so for you do currently pay US Bank a fee for custody for the assets, and all of these banks will charge a fee.
Okay.
And so that's one thing, once we get all of the responses from these banks, one of the sections that we have will detail all of the fees that they charge, because that's certainly what we're going to look at. Not only are we looking at services across all of these custodians, can they do what you all need them to do, but we also want to see what you're going to have to pay each of them to do it. So we'll have all that outlined so you can compare it.
I got you.
To apples.
Okay. All right. Thanks, Chris and Jeff. Appreciate you. And Sue.
And we have also asked, not all of these can do the regular banking, but that's the way we have it now, is US Bank is our, holds our regular bank accounts as well as our custodian. So we've asked, for those banks that could be a bank, to talk about their fees and structure as part of this as well.
Okay.
And
And
so
we've-
let's have a call offline on that, because I'm very familiar with the different fee structures when it comes to analysis statements, and we can, once we get down the line and select a custodian and it may or may not be US Bank, what does that look like on a fee structure, and how does that compare to what you currently have? Because there's no offsetting of the relationship. There's no consolidated fee structure for custodial versus a commercial banking account.
Okay.
So they're not giving us a discount on the banking side because we have custody.
Okay.
Right. Each bank, they're generally going to operate as two different units that they don't shake hands. They do their own things. Yep.
Okay.
Yeah, and the only other thing I guess I would point out on this whole process is we'll need to schedule most likely a special meeting beginning of August to kind of review what we typically do, have the template of the answers to compare, and then make decisions about finalists. And then I think we're targeting the August investment committee meeting to do those interviews of those finalists.
Okay.
All right.
Sue, do you want to jump over to the Manulife fee?
Okay.
And while Sue's pulling that up, I'll sort of refresh everyone's memory that we were, and this goes in part with the Exponent's fixed income discussion, and they are winding down that fixed income portfolio. So we had made the recommendation to move those assets for the time being, or when we do start to get it back over to Manulife. And I know one of the questions that came up, well, first we did look at performance, and Manulife was the better performing of the fixed income managers for the longer time periods. And I know there was a question regarding the fees. And so this just outlines currently the top table, what their fee structure is. And so how to read this and how they charge fees. They do it on what's called a tiered schedule. And that just means for the more assets that you have to put to work, the better rates you can get on a fee. And so how that sort of lays out, you look all the way to the left, it says on the first $50 million that you invest, they will charge you 0.3%. If you invest more than 50 million, and the next 50 million that you now invest will go to a fee of 0.25%, and then another 50 million above that would only be charged 0.2, and then anything over that combined 150 million. So the remainder of your investment, if you had that much with them, would be charged at 0.15%. So for the amount that you currently have, which is 36 million, you see you still fall into that first tier. So everything that you have invested currently is at the 0.3% level. To the right of that, you just see what that is in dollars. It's about $109,000. And then to the bottom right of that chart, again, we tallied it up, but it's going to be the same as where your first tier is. So all in, you're at 0.3% for your current structure. We went back to them and said, we have other managers that are a little bit lower in the fee structure. What can you do for us on fees? And the first thing they came back and commented was, well, it runs a tad bit higher because it's a bit of a quasi core and core plus. So again, think of the core is very straightforward investment grade bonds. In the US, the core plus will do some things like high yield bonds, might do some things outside of the US. More like what Exponence is doing, but Exponence is a little bit more higher octane. So they sort of come somewhere in between, and that goes to their performance, which has been better because of some of the additional strategies that they've done in their portfolio has gotten them that extra margin of portfolio. But they said, nonetheless, let's see what we can do. So they came back to us with the bottom fee schedule and said, they can now lower the first tier on the schedule to 25 million. So that would still be at 30 million, but then you'd go up to the next tier, would now be the next 75 million, and they would lower that to 0.25%. And then anything over that initial 100, again, we're not even close to being there, would be at 0.2%. But now if you break that down, and now this number, so if you see in the assets column, all the way down at the bottom where it's 47,967,000, that is the combined what you currently have invested plus the 11.5 million from Exponence. So that would be the total that you then would have invested with Manulife. So we're applying that to this fee schedule. So the first 25 million you see gets multiplied by the 0.3%, which gives you the $75,000 to the right of that. And then the next piece of it, so the remainder of the 47,967 minus the first 25 is the next line. It's the 22,967,785 that now would get applied to the 0.25%. So the lower tier on the fee schedule. So again, multiplying that, the 0.25 by the 22,967 gives you a fee of 57,419. And if you add those two together all the way at the bottom, that gives you a total fee of 132,419. Now, just on a dollar basis, you see that that's higher than the top box, and that's just because you now have more assets in it that are getting charged a fee. So about 48 million versus about 36.5 million. But if you look at it on a percentage basis, so the percentage of assets being managed, it actually goes lower. So right now, your effective fee is 0.3%. Your effective fee in that new structure would be 0.28%. So you do better all in on your fees with this new structure. So they've agreed to that. It was approved, I think, finalized today. So.
Wonderful. I love lower fees.
So yeah, we knew you'd like this one. So.
Mhm. Yep. Thanks for negotiating that. I appreciate it.
So I guess we did have the kind of hanging recommendation. We've gotten the recommendation to, liquidate Exponence, but then, what to do with those funds then afterwards. There was a discussion.
Right.
Split it or go to Manulife, all of it. So
correct. Thank you, Sue. Because that was, and I think we were waiting on this fee discussion to see if they would help us out on fees. And so again, our recommendation would continue to be to invest the Exponence money as it comes in with Manulife. And now certainly we get it at a reduced fee schedule.
Sounds great.
Okay. We're moving, we're rolling. What's next, Sue?
Well, I do have a motion for that.
Okay,
Okay,
all righty. Who's up next? Make a
To
motion.
recommend to the Board of Trustees approval of allocation from Exponent's fixed income liquidation with the full amount invested between current core fixed income manager Manulife.
Richardson second.
Been properly moved and seconded. Any discussion? Hearing none, Sue, can I get a roll call vote, please?
Angela Banks,
Yes.
Christina Bennett,
Yes,
Louis Cross,
yes. Somebody got feedback coming in again. I don't know who it is.
Sheila Goodman,
Yes.
Yvette Levy,
Yes.
Martell Mann,
Yes.
Bobby Richardson,
Yes.
Albert Sanders,
Yes.
Doris Walker.
Yes.
Okay, once again, we have 9, so the motion carries.
thank you. All righty. Next on the agenda?
Okay, I think we're just down to the flash report, so we're done with the heavy lifting.
All right.
Okay, so this is the May flash report. Sue, if you want to flip forward to the first page.
Make it a little bigger.
And we can see a general look of what the markets did in the month of May. If you look at that top table, all the way to the left, the various indices, and you see it was a bit of a mixed bag. So, but a bit of a follow-on of the trend that we've seen the past several months, which is the market's trying to gain a foothold, and for really there's been more positive news than not, because we've now seen inflation numbers continuing to come down. So that last CPI reading was at 4%, which is again still above the 2% that the Fed's targeting, but worlds better than that almost 9% that we peaked at. So, and again, if you take I'll jump around a little bit, but that bottom right box where you see commodities and gives you a general look. So things that make up big portions of an inflation number, oil is certainly one of them. And we see that those oil prices between the end of the year 2022 and as of the end of May have come down. Gasoline still elevated as a component, natural gas down. And then if you look all the way to the bottom, that BBG commodity, that's just a basket of a bunch of commodities. So you see a basket in general has come down in price. So again, just things that we think about in terms of that what the Fed has been doing with higher interest rates has worked. It's been bringing inflation down, and it worked to the extent that yesterday the Fed said we're going to take a pause. So, but they also hedged themselves significantly and said, while we are pausing, it doesn't mean we won't raise rates more before the end of the year if we have to. So that's really where we're at. But we think it is at least healthy and a good sign that they did take this pause, because they are at least recognizing the fact that it has worked, number one, and number two, the more aggressive that they continue to be with interest rates, then we might see more of a negative impact on the economy and jobs and consumer spending and all of these other things that keep the economy moving in the right direction. So a lot of these things have been good for certain segments of the market. And again, you can see back to that top left table, large cap stocks, that's the S&P 500. Those, and again, think of those as the big Microsofts and Apples and those big companies that are the largest in the index, that have done pretty well. And that's where investors that have really been trying to dip their toes back into equities have said, well, we want to be in equities, but we want to be in the safest equities. So that really gives you that division of why the S&P has that positive return, but then you see things like the Russell Mid Cap and the Russell 2000 index still being negative. Those are mid and small cap stocks. So the market looks at those as still having more risk and having more of an economic risk if we tend to tilt more towards recession. And so that's really why we continue to see that differential in return there. And we also see that outside of the US. So that top box, the bottom two lines where you see MSCI, EAFE, that's EFA, and then below that MSCI EM, which is emerging markets. So those two lines respectively, that the one above that is developed international markets, and then right below that are emerging markets. So again, the world views anything outside of the US as being a little bit more risky. And so investors have been avoiding those segments much more than that blue chip S&P 500. So that's really caused those deviations that we've seen. And again, looking at those colorful boxes on the right, the box to the left of that, those are year to date. And again, you can just see by style, big differentials versus what we saw last year. So last year we saw growth stocks, which are, there's a lot of technology in there. And those really sold off quite a bit last year. This year, everyone is flocking towards those again. So you see that top right green box at 20.8. So that's a 20.8% return so far through May of this year for large cap growth versus large cap value on the left, which is still negative. And that entire side of the equation where you have those negatives, Lewis, this goes back to your discussion and some of your questions on the regional banks. A lot of that mid and small cap exposure it comes from regional banks. And so when they have real bad periods like that, that's you see those types of returns, and that is sort of bleeding into anything value, even if it's large cap. Now, the other thing I'll talk about is that is sort of holding true for non-US stocks as well. And this will come up when I talk a little bit about some of the value exposures we have in the portfolio, that both on an international and US basis, they've had a challenging time. And part of that also being that there's a certain portion of the value market, and your investment managers in the value space are susceptible to this, that they have very deep value names. So they're really good deals because the valuations are low. But you also have managers that have very high dividends, and that's long term, that's really good to have a dividend paying stock. It's almost like having fixed income and coupons from a bond. So for stocks, that's good. Your companies make a lot of money. They pay it out to their investors in the form of dividends. That's a nice thing to have. However, on a short-term basis, the way the world values those is with a model that uses current interest rates. So when we have this environment where the Fed is raising rates, it sort of gets valued like a bond. So, and again, we've talked about this before, that is an inverse relationship. When interest rates are going up, temporarily the value of bonds go down. That also happens to very high dividend paying stocks. So again, a few of the managers, and we'll point to those in a moment when we look at the managers, that have been susceptible to that. So the second section on the left, those are the fixed income indices. You can see all of those negative for the month. So again, just a little bit more of that pressure that we had prior to yesterday when the Fed said we were going to take a pause. If you go back through the bulk of May, really the tone was the Fed might still be raising interest rates for the next couple of months. So again, that was the market, particularly in fixed income, still reacting on a negative basis to the Fed's potential interest rate increases. So at the bottom chart to the left, just a couple things to point out. And I know we talked about this last month as well, but just with what the Fed has done, that top line, which says U.S. generic government 3-month, probably the best or a close approximation to the Fed's target rate or what they've been doing with interest rates. You can see where that is right now, is about 5.4%, but you didn't have to go back too far. So 12/31 of 21, where that was almost zero. So we've come a long way. Again, that's certainly something that has impacted the markets in a short term when the Fed raises rates to that extent over a short period of time, it will have some impacts. Now, the good news on all of that is that anytime a company now reissues a bond, they're doing it at a much higher coupon, and that's good for fixed income investors. So we're now expecting to see much better returns from fixed income, which really has been an asset class over the past 10 years that we've gotten very little return from, just because interest rates have been so low. Now that really starts to be a much more meaningful contributor to your portfolio, and certainly towards that return objective that we're looking to get on an actuarial basis. So all very positive. The only other one that I'll point out in that same chart, which is also a pretty big differential, but again, drives directly from the Fed's policy of raising rates. And that's that bank rate 30-year mortgage. That's the second one from the bottom. So those are mortgage rates. That's what the average person right now has to pay for a mortgage if they're getting a new one, didn't lock in, or if they have a floating rate mortgage that's going to now be reflective of much higher rates. So again, take a look at where that was at 12/31 of 2021 at just over 3%. So that's a pretty big difference when it comes to what your monthly mortgage payment ends up being. And so again, that's one of the things the Fed has to pay attention to in slowing down the economy, because now people stop, either A, they stop buying houses, or if they already have a house, but now their mortgage floats and gets more expensive, well, they have a bigger payment. Bigger mortgage payment they have, the more they, or probably the less they can go out and spend on other goods and services that drive the economy. So again, that's the give and take that the Fed's really looking at right now. So I'll pause there and see if there's any questions on the economy or the markets. Okay, so if we want to jump forward one page. And this is the asset allocation chart. And again, because there was and we'll see when we get to the next page and look at performance, where it was more of a flattish type month, not a whole lot of movement in any of the major asset class allocations. So again, most of them are not too far off from their targets. Where we see the biggest deviation right now is still core fixed income. But again, remember that in that top chart, that the gray boxes are your tolerable ranges. So you want to have the upside down arrow, which is your current allocation. To be in compliance, you want to be in those gray shaded areas. And then when you're completely right on target, you're going to be at the black line. So again, all of the asset classes are still within those tolerable ranges. And this is always what we use as a guidepost when we address rebalancing. But as of today, we would look at it and say there's nothing that causes us a concern from asset allocation compliance. So we would not have any recommendations for any outright rebalancings at this point. Sue, next page. Okay, so here's the performance for the month. And again, as you can see, top line for the month, the total composite was at a negative 1.2%. So fairly in line with the policy. And as you scroll down, you can see a number of the areas where which would have impacted that return the most. And the one that I'll point to was Edgar Lomax. So I want to dovetail back to my conversation on value stocks, because if you look at the magnitude of their underperformance, particularly for the fiscal year period, where they're down 7% relative to their benchmark, which is down only about 1.4%. A lot of that has to do with their structure. Number one being more deep value. So things that were very, very inexpensive stocks that are just great values and good bargains. Just the market hasn't gone to them. And so that's been out of favor. That's their portfolio. And the second is their dividend yield. So they have a very a fairly high yielding dividend portfolio, which again, long-term is good. It shows that they have strong companies that bring in a lot of enough cash that they can pay it out to their investors. All of these are very good long-term things, but the way the world values those stocks is when interest rates are going up, temporarily they will sort of devalue those stocks. So that's been a temporary issue for Lomax. So again, we sort of get that with their portfolio. It's nothing that causes us major concern on the Lomax portfolio. But again, we thought it would make sense just to spend a couple of seconds on it to understand why we're seeing that magnitude. Because again, that's really for the fiscal year period where you're about 3%. And again, not too far off the benchmark, but that'll probably be one of the areas that's causing the most deviation on the return. Before we flip forward and just look at the rest of the pieces, let's talk about the top line long-term numbers now at the end of May. So on a 3-year basis at about 7.6%, which is ahead of the benchmark. 5 years, just shy of 5%, fairly in line with the benchmark. And then the 10-year number and the inception numbers, both over 6% and ahead of the benchmark. So again, as we continue to have some of these better quarters like we did in the first quarter, tack on a good May like we did, April, May cut into it a little bit, and June so far has been really good. So again, fixed income is going to be sort of flat, hasn't been participating as much as in some of the market excitement, but equity indices in the US are up close to 6% right now as of today. So it's been if things continue on this trend for the rest of June, should be a pretty strong month that again just continues to be additive and move those longer term returns more in the direction of what we would expect and to continue to meet that actuarial return assumption that we target. So Sue, if you want to flip forward one page, we can take a look at a few more pieces in the portfolio. So as I talked about before, one of the areas that's been not as much in favor has been mid and small cap stocks, because the market has viewed those as as a little bit more risky, and it's been out of favor. The one thing that we really were happy about in this portfolio, in particular, if you take a look at the 1 year number in particular, but you certainly start to see it as you go out in those longer term numbers as well. Your group of managers has done extremely well. So for the 1 year period, where all in small cap stocks have been negative almost 5%, your group has really protected capital and hasn't lost much money at all. So they've just done a very good job. And so you can see Westfield, who's been for the past year positive ahead of the benchmark. Systematic, they're down, but their portfolio, which is, again, think of that double whammy of the areas I said have not been in favor. So a small cap and value, two of the toughest areas of the market, and index down 11%, systematic only down 1%. So they've just done a really good job of navigating what's been a tough market there. And then DFA still negative, but ahead of again that micro cap, small cap value area of the market that's been challenging. So they've certainly done a good job. Right below that, you see where your two combined managers again for the fiscal year very well. Again, international stocks, they're positive, but they have trailed some areas of the U.S. market. But your managers as a group are up almost 12%, so well ahead of the benchmark for the fiscal year, and that's been very additive. Again, another tough area of the market right below that has been emerging markets. You see for the fiscal year period, still positive on a benchmark basis at 1%, but your combined managers are almost plus 6%. So just an exceptional job there. And then for that 1 year period, again, a real tough time period for the indices and for the market in general, down 8.5%. But your combined managers have protected very well, down less than 1% for that 1 year period. So that's again just a fantastic thing to point to from a diversification and portfolio construction and minimizing downside concept. Sue, flip forward one page. Okay, so Exponents, and again, their team talked a little bit about portfolio structure and things that they're looking to do. So as we go forward, I know certainly they take a look at their fiscal year numbers, and we try not to be too hypersensitive to short-term numbers, but they are off the benchmark, and certainly the ones that stand out the most are going to be Foresight and Martin. I know Foresight in particular, we would have to go back to that conversation of deep value. So they are in that bucket, and they also have a very good portion of those high dividend paying stocks in their portfolio. So that's been a short-term negative for Foresight. But again, we still believe that the overall diversification of this product is designed to work out well. And again, once they move to this new structure, and we'll expect that they probably will bring in a few more of those managers. Remember those different colored dots they showed you on the chart, which would be areas to further diversify the portfolio. So that will ultimately help. And so hopefully we start to see more periods where, like an ARGA, where they're up at 7% for the year and well ahead of the benchmark. So we'll expect to see more of that better performance out of those sub managers for Exponents. Next page, Sue. Okay, so the fixed income managers, you see in total for the fiscal year period, all of your fixed income managers at about 2.6%, and that's ahead of the benchmark. So again, that environment has gotten better. These managers have been able to find better coupon yield, and now we're really starting to see that in the returns. Again, notwithstanding the past month, which was a little bit more negative across most of the categories, but again, the trend, at least coming off of the first quarter and then with April as well, have been a little bit better. Your opportunistic managers have also continued to do well and diversifying out the portfolio, and all of those managers have been in line with or ahead of their benchmark for the period. Scroll down a tad bit more, Sue, so we can see the Exponents fixed income. So again, that's going to be in certain stages of liquidation, but as we continue to see a rebound in the market and more of a focus on higher yielding fixed income securities, we should expect to see more periods like we've seen for the fiscal year for them. So they have had a nice rebound relative to where they were last year. Last year, not a great year, but they will start to recoup some of that. And again, we know that they will be opportunistically looking at pricing on securities and making sure they get good returns before they're liquidating things. So again, that's why that process of liquidation is going to take probably a bit more of an extended time for that portfolio. One more page forward, Sue. Okay, and then these are the global asset allocation managers. PIMCO, their month was behind, so some of their international securities and some of the areas that they're at in fixed income have been a little bit more out of favor. You can see that even more in the fiscal year in 1 year period. Remember, that's sort of a go anywhere portfolio, so they can be in the US and international equity markets and fixed income markets, and they have the ability to really toggle that allocation between equity and fixed income based on what they're seeing in the market. So again, some of those short-term magnitude of returns to the benchmark have not been as good, but ultimately, as we start to shift and go into a different mode of the economy, we expect they're going to capture a little bit more of upside within that portfolio. Again, less than 3% of the total portfolio, and it's targeted at 3%. So not moving the overall relative performance needle to a huge extent. And then the hedge funds continue to do well in this volatile environment. So you see in aggregate for the fiscal year period at 4% relative to their overall benchmark. The Entrust, again, that's very small. So when you see that magnitude of return, that's not, it's terrible. It's one position that gets repriced on a crazy basis. every month, but at only $126,000 of a balance, it's really not impacting the bottom line of the system's return. And then White Box and Grosvenor both have nice, solid, positive returns for both the fiscal year and latest 1-year period. And that White Box return for the 3-year period also certainly stands out at almost 15%. So again, not the largest pieces of your portfolio, but good diversifiers, and certainly act as that downside risk governor when things are out of whack in the traditional equity and fixed income portions of the portfolio. And that's really it. The following page, we don't have a whole lot of updates. Those are the privates, and we always get a better look at those on a calendar quarter end basis. Any questions?
Not for mine. Anyone else have any questions?
A few minutes early today.
Sue, anything else on the agenda?
No, nothing else on the agenda. Just a reminder that we will not have a meeting next month. Investment committee meeting, yeah.
Okay.
And who is going to NASP in July?
I'm going.
Lewis?
Is that
I'm
the
going.
one? Is that the one in Philly?
Yeah,
Yeah.
yes.
Yeah. Yeah, I'm going.
Yeah, I'm going too.
Who's that? Oh, Bobby.
Bobby.
Okay.
Mhm.
I plan
Anyone
on going. I plan on going. I just gotta get all
Albert?
my stuff together and tell soon.
Come on, Albert. Anyone else?
So
Just register you.
that's NASP is one. That's the one in Philly, and then the one in Lake of the Ozarks.
Okay,
Right.
well, both of those.
And then the one in Virginia as well. What is that one?
That's NCTR.
National Council of Teachers Retirement.
Right. Yeah, I'm going to go to that one as well.
All righty.
Which one are you going to, Christina?
I'm only going to NASP this year and NCTR because I'm on a committee at NCTR.
Right. Right. I remember that.
Right, and I'm on the committee also. I'll be
Bobby,
there.
you are at NCTR?
Yep.
All right.
Okay.
Okay.
Man, we got some important people on this.
Yeah, ain't no doubt about it. Autographs are in order for this kind of thing.
Yeah, I'm on the trustee education.
And I remember you last
yeah.
time. Yeah.
Yeah,
Right.
for NCTR. All right. If there's no other agenda items, can I get a motion to adjourn?
I would like to
Did
make
we
a
make the
motion.
motion that we adjourn?
Well, I second that, Sheila.
All those in favor, please say aye.
Aye. Thank you, Jeff.
Motion carries. Thank you, Jeff.
Thanks,
Thank
Jeff.
you, Sue. I appreciate
Hey,
it.
thanks, everybody. Have a good
Thanks,
weekend,
Jeff.
and hope everybody-
Jeff, are you going to the
everybody's
Lake of the
summer's going well.
Ozarks? Jeff, are you going to the Lake of?
I will see you. I will see you all at the Ozarks, whoever's going, and for whoever's coming out to Lake Geneva, we'll see you out there as well. So
Okay.
Thanks.
Okay.
All
All
right,
right,
bye-bye.
thank you. Bye-bye.
Good night,
fantastic. Have a good
everybody.
Good night, everybody.
See everybody soon.
Good night.
Bye-bye.